So Rocket Mortgage agreed to buy Redfin for $1.75 billion. So what happened after that? Redfin, the stock went from about $6 and some change to now $10.70. It's over 60, almost 70% increase in that stock on the news of the acquisition. Now, I always say do not invest on news. Based on news is a bad idea. Number one, not all acquisitions that are announced actually happen. Sometimes these mergers and acquisitions fall through. For whatever reason, they don't always happen. It's just a news release. Redfin and Rocket Mortgage, they put that out. Of course, they want their investors and potential investors to be excited about it. But you know me, I'm going to look at the fundamentals and we're going to allow the actual results of the business. We're going to allow that to tell us a story or impact our story and allow that to get us excited about the business, not just a news release or a press release. So let's look into these two companies really quick. Trust me, it's not going to take long because there's not much to look at, and see if we should invest in these companies or if this is like something that we're invested in. So look at Redfin really quick. Stock is trading at $10.70. Now, when I look at a stock ticker, the first thing I do, I go straight to that PE ratio. I'm like, no earnings. So right off the bat, if you want to be a smart investor, a safe investor, and these are the type of investors that do better in the market than the ones that want to take on so much risk, why invest in a company that's not earning anything when there are so many other businesses that have been earning for such a very long time at high margins? Why take that risk when you don't have to and you know you're going to do well? That's first and foremost. So earnings per share, negative $1.36. PE ratio, they don't have one because they don't have earnings. Let's see, a beta of 2.9. So this stock is highly volatile, almost 3 times the volatility of the overall market. That's what it's saying. If the market goes up $1, this company will go up almost $3. But if the market goes down $1, this company goes down almost $3. Okay, so again, not much to look at. We see that spike here when they made the announcement, really sharp, high volume, lots of buyers, and even more. It kind of went up since then. So I thought it was going to pop back down, but it stayed up. Great. So let's look at Rocket Mortgage. Rocket is the company that is looking to buy Redfin. $14.87 per share. Let's look at the PE, 70.8. That's very high. That means for every $70 you invest in this company, that earns you $1 of the company's earnings. That's what the PE ratio is saying. So that's really expensive, very high beta, so very volatile, lots of movement, market cap of $29.5 billion. And over the past 5 years, we see that this stock is down 17.39%. So this company hasn't been doing a whole lot of gains as far as the market. Flat for the most part, but down and hasn't really recovered from this dip in 22 and 23. So not really much to look for there. So let's look at the financials of Redfin. Let's look at the company that's looking to be acquired. All right, looking at the revenues. 2015, 187 million. They got to a billion mark in 2021. Look at that, 117% increase. And then 22, 2.2 billion. 18% increase from there. Pretty awesome, pretty significant. But look at 23, minus 57% decrease in revenue. And they popped back up to 6.8%. So if you were to take out these years, we understand with COVID, there was many people looking to buy with not a whole lot of building going on and not a whole lot of people looking to move. So prices were really, really high. They were inflated. That was what you call an environment that was not normalized. So if you're going to look at a real estate company and you have years like this where the economy in that industry was not normalized, you got to be very careful making decisions on the results of those companies for those years. Many times if you're evaluating a business and you have these years that are not normalized, you will exclude them from your analysis. So you're looking at a normalized environment, protecting yourself from making a bad decision. So with these two companies, because they're in the real estate, that's a smart thing to do. Look at these years. Okay, you can see what they did. Ironically, those years that they had high revenues, they had lower margins, 21 to 25%. So that's interesting as well. But they dropped right back down to 1 billion. So it's great that they're over that billion mark. But look at this. They continue to pretty much trend along here, and they're really much back on their normal trend of minimal, or I say modest gains per year in revenues. Cool that they have these 2 years, but again, this is not a normalized environment, so we want to make sure we're not making investment decisions based on that. So let's go to the next section. Let's look at net income. Is Redfin a profitable business? Absolutely not. Since 2015, they've had a loss every year. And not only that, the losses are getting bigger. It's not a situation where losses are getting smaller as this company gets closer and closer to profitability. This business continues to lose money. I don't know why you want to throw money out there. Well, I know why people do it. Emotions, news, excitement, bunch of bull. We don't do that. Negative, 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 all the way through every year. Even with those years of high revenues in 21 and 22, they still didn't turn a profit. These were two of their bigger years of losses in their biggest year, 22. Come on now. Doesn't make any sense. If you're going to make a ton of money out of the blue, you should be profitable, but no, which means management has not figured out how to make money yet. They're running their business. They don't know how to make money. Free cash flow up and down as you would expect, more negative than positive. Again, nothing to look at. This should be a quick analysis. Balance sheet, horrible. And I say horrible because I like businesses that have cash flow enough to pay off their debt in 3 to 5 years. 3 to 5 years, sorry about that. But here, look, I understand this is a different type of business where you might have different balance sheet structures, different leverage structures, but 58 years to pay off your debt, 18 years to pay off your debt. Companies typically can't survive by having horrible balance sheets like this. And it doesn't seem like it's getting better, seems like it's getting worse. So why would you invest in a company like this? I don't know. Of course, they're not paying a dividend, and you know they're growing their shares. You know they're selling shares, they're bringing in money because they're losing money every year from their operations. So they have to sell shares, bringing in more and more and more shareholders, diluting their shareholders to bring in cash so they can continue operations. I'm not liking anything I'm seeing right now. Of course they have negative returns on capital. So look, we want businesses that are earning a return on capital higher than their cost of capital. Average 5 years, cost of capital 4.7%. Average 5 years, return on capital -13. This means this company is not only spending more than what they're bringing in year after year. When you look at their capital, their equity, and their debt, they don't even return. It costs them 4.7 to get that capital, to get the equity and the debt, and they're losing money on it. So they're not even building economic value as an entity. I'm not going to waste time valuing the company. I'm not wasting math on this. Why? Okay, now, quickly, let's look at the company that's going to buy this company. Surely they have some positive things to look at, positive revenues. I don't know. Let's see. 2015, 2016, not available. So they went public in 2017. Let's see, 4 to 15 billion in 2020. We know what was going on in 2020. That makes sense that they would have a 212% increase there. But then negative, 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 positive. So 4.9 in 2019, they had these years. 1 year they were below, so they had a dip. And they're barely above where they were in 2019. Again, you have to be careful and not count these 2 years where the environment was not normal. So ignoring these 2 years where, of course, the environment wasn't normal, same or similar to Redfin, this company isn't really doing much. This is the people who are going to spend 1.75 billion on Redfin, but their revenues are not consistent. Let's look at income. So they are making some income. They are making some profit. Okay, cool. 771 million. Of course, we have these 2 years here. A loss in 23. So they're not consistent. So they do have more. Only 1 year of only 1 year of negative profit. 1 year of loss. So they have profit consistently, but it's a whole lot smaller. 29 million when you were at 771, at 894 million. Now you're only at 29. Wrong direction. Not liking it. Let's go on to the next one. I think I'm spending too much time on these trash companies. Cash flow negative. What's this? 1, 2, 3, 4 years of negative out of the last 8. Okay, of course, he has 2 years, but barely had anything there and had a big loss. I don't understand what's to get excited about this, but hey, what do I know? Okay, so interesting. I got to double check this. So apologize. I probably should have checked this. It doesn't make sense that they wouldn't have debt here. So maybe the numbers just didn't pull in clean. So whatever. Sorry about that. So shares outstanding, similar story. They're selling shares, so you're being diluted. So that's not good. Let's look at that economic value. Okay, so they do have a return on capital for the past 5 years, but they have a much higher cost of capital. So they're losing economic value at a rate of 6.7% per year. I don't understand what's to get excited about this when you have Google, Microsoft, Nvidia, Meta, Apple, Lowe's, Home Depot. You got so many great businesses to invest in. I don't understand why this warrants attention from people, but it does. Again, I'm not wasting my math evaluation on this. So look, again, don't invest off of news, invest off of fundamentals and what you believe the business is going to do in the future. Now, maybe you're in the real estate industry and you see a path to profitability. You see where this merger is going to make sense. You have the Redfin with their agents, and then you have the Rocket Mortgage with their mortgage background, putting them together. Okay, it's going to possibly cut some costs. It's going to create some more efficiencies. Maybe it is a good deal, but why take the risk now? Here's one thing about investing that I really enjoy, and this is why I try to get people who are into gambling to understand. If I'm gambling on a game, I really don't know who's going to win. I just think I know. I know Google is winning. I know Microsoft is winning. They've already won. I can just invest in those companies that have already won, and I know I'm going to do well because I know they'll continue to win in the future because they are superior to their competition. Investing is not like gambling. It's really simple. I can wait to imagine gambling, and you are going to say, hey, I'm going to wait till the game is over. Then I'm going to pick the winner. Then I'm going to place my bet. This is what we get to do with investing. We can wait till the game is over, practically, figuratively, and then see who's winning and invest in that company. It's really simple. This is, I think, a dangerous play. 5 years from now, it might be a different story, but right now, does not make sense to invest in this when there's so many more opportunities to invest. And we understand that the valuations are kind of high. The market is going towards correction, potentially a recession right now. So who has money to be out there risking like this on a deal like this, where you have a company that's not consistent buying a company that's lost money every year that it's been pretty practically in existence. So it doesn't really make sense. Be careful. Don't make silly decisions like this. So hope you enjoyed this video. Hope to see you in the next one.